Hello everyone, welcome to Demand Supply Trading Practical session number 1 for the year 2026. Myself Sujit Kakkar, and today is Sunday 1st of Jan 2000, sorry, it's not 1st of Jan, right? My bad. Let me fix it. Right, so today is 4th of Jan. So just give me a minute. I'll quickly fix this. Just a few more seconds. All right, so perfect. This has been fixed. Yes, so today is Sunday, 4th of Jan. Wishing you all a very happy new year. This is the very first session for the year 2026. And yes, before we move ahead, let's also get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you with content related to demand supply trading, plus the schedule for these live sessions. That is where we post it as soon as these sessions are scheduled. So just to be updated so that you can plan your day accordingly in case you want to join these sessions live, you can join this Telegram channel. And plus, like I said, we also keep sharing content related with demand supply trading methodology, or even if we have any promotions or offers coming up, that is where we post it well in advance. All right, now how do you join this channel? There are a few different ways you can do it. The first one is you can scan the QR code which is on your screen. Second, if you go to the description of this video, you will be able to find the direct link. You can use that link to join the channel. And thirdly, when you visit our website, which is sujitkakkar.com, or you can use the short URL, that is sk.coach. So once you are on our website, let me just quickly show you. You can just scroll down on any of the pages, and in the footer section you will find this banner that says join Telegram channel, and next to it you have the join now button. You can click on this button and you can be part of the Telegram channel. All right, so that takes care of how to be part of our Telegram channel. Next, talking about today's session. Today's session is practical application of demand supply methodology. So our demand supply course is available as a 100% free course where you can learn the complete methodology and understand how to identify zones, how to qualify zones, how to plan trades using demand and supply. And what happens is when you go through the course content, you basically learn the methodology theoretically, but unless and until you see some practical examples, at times we don't get a very good understanding of how to implement it. And that is what we do in these practical sessions, that every weekend I do a practical session where I take some real life example to which we apply the complete process so that you can understand how to plan trades very mechanically and rule based. Now, there are two advantages of these sessions. Advantage number one, in demand supply methodology, whatever analysis we are doing it in advance, which means we are not analyzing something which has already happened. We are analyzing what might happen in the future from our area of demand or from our area of supply. So again, we are pre-planning our trades. We are not reviewing something which has already happened. And nothing can be more transparent than this because you're always pre-planning. And just because we are pre-planning does not mean that I share the example with you and then we forget about it. Whatever examples I share with you, whenever they get triggered, we also review them. So what happens is you get to see both the before as well as the after. And in fact, if you would have gone through the last session, we did the review of all the examples that I shared with you in 2025, where you could see how the methodology performed. Though we did have two trades which were getting carried forward for us because we did not get an exit on them. So we will be starting with the review of those two trades today. But again, whatever we are analyzing it beforehand. And since you get to see the before and as well as the after, once the trades they get triggered, nothing can be more transparent, and that helps you build confidence in the methodology. Now, the second advantage of these live sessions is because these are live sessions, if you have any questions, queries related to demand supply trading methodology, or even if you have some generic questions, queries related to trading, I can always put it in the chat box, and at the end of the session I try to answer all the questions that we get during the session. So definitely, if you have any challenges, put it in the chat box. At the end of the session, I'll answer your questions, queries. Okay, now to be comfortable with these practical sessions, there are few prerequisites which you people have to complete. So let's also touch upon these prerequisites. The very first one is the Trading Essentials course, optional for people who already have a very good trading background, have been trading for a pretty long time. If they want to skip it, they can. That is why it says optional. But otherwise, I would highly recommend, irrespective whatever your background is, do start with the Trading Essentials course. Now, how do you access the Trading Essentials course? Very simple. Once you're on a website, under services, go to the courses option. And you can see the very first one is Trading Essentials. Click on Trading Essentials. The course is available in 2 languages, English, Hindi. So whatever language you're comfortable with, just click on it and it will give you immediate access to the course content. No signups required, no registration required. Just go through all the lessons, and once you complete all the lessons, that basically completes your Trading Essentials course. Now, after completing Trading Essentials, the next step is the Demand Supply Trading course. Now, how do you access Demand Supply Trading course? Same steps. Under Services, go to Courses, and instead of Trading Essentials, this time you have to select Demand Supply. Click on it. And you can see this is also available in 2 languages, English and Hindi. So whatever language you're comfortable with, click on it. You get immediate access to the course content. Go through all the lessons, and that will basically cover your demand supply trading course. And again, what happens is once you go through the course, you will learn the process theoretically, right? But you also need to see some practical examples. So for that, you can also access the recordings of the previously conducted live sessions. And how do you access those recordings? Just click on practical sessions, and these are also available in English and Hindi. So again, no sign up required, no registration required. When you click on these buttons, you get immediate access to the course content, and that will cover, so this will cover your examples of how to implement demand supply trading methodology. So again, all these sessions that I do, they are recorded, and the current archive is more than 2 years of recording. So again, the more number of practical sessions you will see, the better you'll start having the understanding of how to implement the methodology. Now, during these live sessions, you will also see that I use 2 documents. One is the rulebook and the other one is the flowchart. Now, how do you get access to these 2 documents? Again, very simple. On our website, under Services, go to the download section, and in the download section, you can see you have your rulebook and you have the flowchart. So this is your rule book. Now, how do you use this rule book? Once we go through the practical sessions, you will understand it easily. And how do we use the flowchart? Again, you'll experience it during the practical sessions. So again, these are the prerequisites. And before we get started with our analysis for today, let's also review the 2 trades which when we did the review last time were open trade for us, and see what the outcome have been of these 2 trades which were pending for us. So starting with the very first one. So this was from session number 21. I did the session on the 21st of May. And the prices came into the zone on this particular day, which was on 24th of December. And you can see after coming into the zone, we got a bounce, which was a little more than 1:1. So what we do it as at 1:1, we make it as a break-even trade. And then you can see that few days ago, prices again came into the zone, though the zone has not yet been violated. Now, you might say that I don't see any zone here. Why are we marking? So if you go through the session, you will see this was probably a case of level on top of level. So we went for the lower level, and that is where we are getting the reaction from. But anyways, this would have ended up as a break-even trade. So whatever review we did, like I said, even during the review, the worst case scenario is we will still have the same number when it comes to the reward to risk ratio. Yes, if we get the targets, it can improve, but it cannot go down now. So for this example, which was getting carried forward, this would end up as a break-even trade. And let me also bring up the next example, which got triggered, but we were still waiting for the exit. Now, this was from session number 46. We did the analysis on 30th of November, and the prices came into the zone on the 17th of December. And you can see as of today, we are somewhere around, so this is my 4:1, then probably 5, 6, we are close to 7:1. And yes, even if you look at your target one, which is at 2:1, you could have easily got a 2:1. But the fact is we were trading at best location, and at best locations, you can always take your targets from the intermediate time frame. Now, the fact is on the intermediate time frame, we didn't have any opposing zone. So this is a trade where if you just want to keep trailing onto it, that can be done. But let's take it as the conservative approach. Let's assume we would have exited exactly at a 2:1 because that is where our opposing zone was. So again, talking about this trade setup, this would have added a +2 to whatever review we did. But yes, if you were trailing onto it, holding onto it, currently you might be somewhere around 7:1 on this. Now, again, like I always say that after this has happened, we are not analyzing it. If you go back and you watch the recording of 30th of November, at that point of time, the chart would be something like this, right? So we did the analysis on 30th of November. So 30th of November will be somewhere around here. So if you go back and watch the review, when we did the analysis, the chart was something like this. And then you can see prices came into the zone, touched the zone. That is where we started moving up. And in fact, if you go through the review of the complete 2025, you will see so many examples where we had the opportunity to buy the low of that particular symbol for the complete year, right? People generally say that you cannot buy the lows, you cannot sell the highs. Yes, it is not possible if you don't know the methodology, right? If you know the methodology, yes, you can buy the lows, you can sell the highs. It's a piece of cake. It's just that at times people are not aware of the methodology. They are not aware that there is a strategy which can help you achieve that. All right, so that takes care of the examples. Oh, my bad. I think I did not share the second example. Just give me a minute, my bad. There it is. So here you can see this was the second example, which was from session number 46. We did the analysis on 30th of November. And like I said, prices came into the zone on the 17th of December. And currently we are almost at about 7:1. And like I said, even if you were looking for a 2:1, you could have easily got it. We were at the best location from where the targets can be used from intermediate time frame, and on intermediate time frame you can see we don't have any opposing zone, so it was a trade where you could just keep trailing onto it. But even if we take a conservative exit of a 2:1, this would have added a +2 to whatever review we did. And again, like I was saying, that it's not that after the move has happened we are analyzing it. When we analyze this particular trade, this was on the 30th of November. So your 30th of November would be somewhere around here. So if you go back and watch the session number 46, when we did the analysis, the chart was something like this. And then you can see prices came into the zone. That is where we started moving up from. And that is what I was talking about, that people, they generally say it's impossible to buy the low, sell the highs. You go through the review of year 2025, you will see so many examples where we were able to buy the low of that particular symbol for the year 2025, right? So it is possible if you know the methodology. If you don't know the methodology, obviously you will feel that there is no such way to do it. All right, so now that we are done with the reviews, let's get started with our example for today. So just give me a minute. Yes, Raj, I realized that I did not bring the chart back again, but yes, I have done the review again by bringing up the chart. Now just give me a second. Let me bring up the example for today, which we will be analyzing. So just a few more seconds. Perfect. Great. So let's get started with our today's analysis. Now, whenever we talk about trading, the first thing I always say is that trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. In case you have not yet watched that video, the link is available in the description. Do watch that video. Very, very important. There is no bypassing it. Eventually, everyone will have to go through that process. So the sooner you start, the better it is going to be for your trades. Now, what that basically talks about is that you need to have a trade plan using which you will start taking your trades. Now, the challenge is when you start learning trading or when you start learning a new methodology, it's not very easy to create a trade plan from day one. And the reason for that is, to create a trade plan, we need to have a good enough understanding of that particular methodology, which only comes with time and experience. So that is why, to overcome this challenge, I have created a ready-made trade plan for you, which is a combination of two documents. The first one is your trade plan steps, which basically tells us what we need to do as a demand and supply trader step by step. And the other document is your rule book, which basically covers all the rules that we will be using while we are planning our trades. But mind it, this rule book is a conservative approach. Why? Because when we start learning something new, it always makes sense to start a little conservative. But as you start having experience, you start gaining confidence in your analysis, you can always make modifications, because no two traders are the same. Different traders, different personality styles. So yes, you will have to tweak the trade plan a little bit to make it more in sync with your personality style, but at least you do have a starting point using which you can start planning your trades. So what is your step number one when you start planning your trade? Your step number one is you need to define your trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit here, the exit can be the target, the exit can be break even, the exit can be the trailing stop loss. The exit can also be the stop loss, right? Any kind of exit. So do not assume by exit I only mean profit exit. Exit can be in profit, it can be break even, it can be loss, any kind of exit. So now the question is, why do we start with the trade purpose? And the reason we do that is because when we do our analysis, the charts that we use, they are time-based charts, and we have n number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these n number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. we go with a very logical approach, and that logical approach is that the longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, by definition, I say daily income is a trade which can last for a day or few days. Just give me a second, please. So like I said, daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, so let's take example of NAC India, which is not a 24-hour market. I'm pretty sure you people would have experienced that whenever the market opens, some symbols they gap up and some symbols they gap down. Now, because of this gap up and gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight in a market that is not a 24-hour market, we do have that risk of a added gap, right? So that gap can give me advantage, but it can also give me disadvantage. So this is where my recommendation to all of you is that initially your hourlies and dailies will be strictly intraday trades. You will not keep these positions as overnight positions and take that unnecessary overnight gap risk. But when it comes to weeklies and monthlies, we have no choice. We'll have to keep these positions as overnight positions because we're not anticipating to get the exit the same day. So these can take few weeks or even few months, but that does not mean that they're immune to a gap. A gap can still happen for a weekly income or a monthly income trade. But since we are leaning against some bigger time frames, the probability definitely reduces, but it can still happen, right? So again, initially hourly, daily, strictly intraday, weekly, monthly, they have to be overnight. But with time, with experience, if you want to include daily incomes into overnight trades, that can be done, but again only when you start feeling that confidence in your analysis. All right, so again, step 1, I need to define my trade purpose. Let's assume I opted I want to plan monthly income trades. Now once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 on the rule book, we start with the topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the high time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Like in this example, I want to plan monthly income trades. So now I know as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine-tuning the zone, type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. So again, before we move ahead, very important thing which I would like to add here. Can you see this table which we are looking at? This is specifically for the NSE market because this market is only open for about 6 hours and 15 minutes. If you're trading markets which are open for longer durations, like you have your commodities, forex, maybe cryptocurrencies or some international markets, then you should be following the table which is on page number 32, right? So again, do ensure you're selecting the correct table based on what markets you're trading. But since I'll be taking the examples from NSE, I will be following this table. So again, as soon as I opted my purpose of trade as MIT, I got the clarity that my time frames now will be monthly, weekly, daily, and 60. Plus, I also know what is going to be the purpose of each and every time frame. So my challenge number 1, what time frames I should be using, what analysis I need to do on each and every time frame, I have crystal clear clarity to it now. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but the next challenge is that on NSE, I have over 2,000 companies listed. So humanly not possible that every day I sit and analyze 2,000 companies to identify my opportunities. So what I need to do now is I need to have a process in place which can help me get a smaller list out of this big list. And the way we do that is by selecting scripts using some computer programs, and these computer programs are called as scanners or screeners. If you'll do a Google search, you'll able to find n number of free scanners, free screeners, which are either based on conventional technical analysis or fundamental analysis, and they can help you get a smaller list. But there was no scanner which was built on demand supply trading methodology. So that is where I have also created two custom built tools. One is called as the demand supply zone alerts. The other one is called as the demand supply zone screener. Now, if you want to have more in-depth understanding of it, what you can do is you can visit our website. Just give me a second. Under services, go to TradingView indicators. And here you can see you have the alerts and the screeners. Click on subscribe now. It will take you to the product page, and that is where the walkthrough videos are available. Just go through those walkthrough videos. That will help you understand these tools more in depth. But what I'll do is I'll quickly brief you what these tools are doing. So let's start with the very first one, which is alerts. So what alerts basically do is, now the first thing you need to remember is when we talk about alerts, alerts only work during the live market. And as of now, only the crypto market is live. So I'll show you examples from the crypto market. So what you can see is currently I'm on the 5 minutes chart, and in the alerts, what I've done is I have given a list of about 20 symbols. And since I'm on the 5 minutes chart, now again, the way the alerts will work for you depends upon your account type with TradingView, right? Let's say if you have a free TradingView account. So what will happen is on a free TradingView account, you will get a table like this on your chart. And as and when you will have formation of demand and supply areas during the live market, this table will keep getting updated. Now, if you have a paid account, you can also create your alerts, right? So what will happen is you will have this table getting updated on the chart. Along with that, you will also get alert notification. Like here, you can see I've been getting these notifications. So again, during the session, if you get some notifications, I'll show you example. But just to see something currently, let's say we go to the very first one, which is BTC USDT. So if I go to BTC USDT, and let's change this to crypto. So you will see that we have a drop-based rally structure. So can you see as soon as this drop-based rally was formed, you can even check the numbers, 91414.75, 91414.75, and 91360.72, 91360.72. So this is what alerts does, that during the live market, as soon as a formation of a demand area or a supply area happens, it gives you that update. Now, how you get that update completely depends upon your account type with TradingView. If you have a free account, it will be as a table on the chart. If you have a paid account, you can also create your alerts to get these notifications, which can be maybe you want notification on your app, maybe you want it through your email, right? Whatever notification options the TradingView is providing. So that's your alerts. The other tool which I was talking about is the screener. Now, how does the screener works? Now, again, for the screener, it is not mandatory for the market to be live. Screener will work in live market. It will work even if the market is closed. And excuse me. Here you can see that in the screener, I've given a list of about 15 symbols. And then I have given my proximity setting as 2%. So what I'm telling the screener is that out of these 15 symbols, on whichever symbol the current candle is within 2% to a demand zone or a supply zone, shortlist for me. Now, the reason I'm doing this is because I only want to analyze symbols where I'm almost about to enter a zone, because if I'm closer to the zone, then only have the possibility I might be able to trade. If I'm very far away from the zone, I might not get the opportunity on Monday. So now you can see out of those 15, not even a single symbol is close to a demand area or a supply area. That is why nothing is getting shortlisted. Now, just think about it. If I was doing the analysis manually, I had to go through all these 15 symbols one by one. But now using a screener, something which would have taken me maybe half an hour or 45 minutes, within few seconds, I'm done. That today, out of these 15 symbols, there is nothing that I need to analyze, because nothing is closer to a demand area or a supply area. Now, just as an example, if I push it up from 2% to maybe 3%, let's see, do we get any results? Can you see it's refreshing? Now, can you see at 3%, it is telling me Axis Bank has proximity to the demand area. So just as an example, if I open Axis Bank, So you will see that the current candle on Axis Bank, can you see we have a demand area which is close. And if I look in terms of percentage, you will see this will be within 3%. Can you see it's 2.29%. So now again, imagine that if I was doing the analysis, I don't have to go through 15 symbols. I know Axis Bank is the only one where I'm closer to the demand area. Maybe I can only analyze this. And that is how the screener basically works. And in fact, what I can also do is, let me just push it back to 2%. Just as an example, let's go back to 2%. Now let's assume I don't have anything on the daily. Maybe I can go to the weekly. And now what you will see is that I will get results based on the weekly. Can you see on SBI, and it is telling me that I'm closer to demand area, and same applies to Tata Steel, SBIN. You will see that we'll have a demand area. We are closer to it. So that is how screener basically works. So again, in a nutshell, a screener helps you identify symbols where the current candle is close to a demand area or a supply area, and alerts, they help you identify symbols where during the live market you are having formation of a demand or a supply zone. So again, yes, these two tools are available, but at the end of the day, you need to remember, irrespective what scanner or screener you're using, whatever results you get from those scanner screeners, you can never blindly buy or sell those symbols. Scanner screeners, they do not tell you what you need to buy or sell. They only help you get a smaller list of symbols which you need to analyze manually, match them with your trade plan. Whatever matches with your trade plan might be an opportunity for you. Whatever doesn't match with your trade plan, you simply skip it, right? So that is how you shortlist your symbols. So again, let's assume we got a list of symbols, and in that list, the very first one was ABC. So what am I supposed to do now? On ABC, I need to go to the lower time frame. So the question is, what is my lower time frame? We got the answer from our step number 1, that as a monthly income trader, my lower time frame will be daily. So I'll go to the daily chart, and on daily chart, I need to identify a zone. Now, I also do understand that identifying zones, in fact, identifying quality zones on the chart in itself is a challenge. And to overcome this challenge, we have also created, in fact, let me do this. Can you see, I just got an alert, so I just wanted to show you example. So this is how alerts, they work. Can you see, as soon as the zone formed, we got the notification. So if I go to this particular symbol, which is PEPEUSDT, you will see that as of now, we'll have a drop-based rally. Can you see, as soon as this drop-based rally was formed, we immediately got the notification as an alert, and even it was updated on the chart. So that's how alerts, they basically work. All right, so going back, like I was talking about that, I do understand that identifying demand supply areas in itself is a challenge. So we also have an indicator for it, which does the process automatically for you. Like you were seeing on the charts that these zones are getting marked automatically, and we provide a 100% free 7-day trial of this indicator. So if you've still not taken the trial, the direct link should be in the description. But the other way you can get access to this trial is you can visit our website. Under services, go to TradingView indicators, and you can see the very first one is the zone indicator. When you click on it, you will get this option, which is a 7-day free trial. Click on this, and you just have to fill this form, which should take you less than 30 seconds, a very small form. You just have to provide your full name, and then you have to provide your TradingView username. In case you don't have a TradingView account, you can click here, you can open a new account on TradingView, and the indicator works 100% 100% perfectly, even on a free TradingView account. So it's not required that you need to have a paid account to use the indicator. You can also use it on a free TradingView account. Again, whatever the limitations of those free account is, within those limitations, it will work perfectly. But just as an example, for few markets on a free account, you might not have live data for your charts. But if I talk about the NSE, we get live data for NSE. So even on a free account, you have live data for NSE, and you will be able to use the indicator on a free account. Now, if you already have an account on TradingView, then you can click here. You can access your TradingView profile, identify your TradingView username, and provide your TradingView username in this column. Now, very, very important, always ensure you double check before you fill this form and you are providing your correct TradingView username, because if you provide an incorrect TradingView username, it will not get activated for you. It will get activated for the person to whom that TradingView username belongs. Right, next is your email address, on which date your trial will expire. How did you hear about us? Click on I'm not a robot, click on I've read the agreement, and go through all these terms and conditions and policies, right? So go through them, and if you agree to them, click on this and then click on finish and start free trial. The reason it is disabled as of now is because the form is not filled. Once you fill the form, this will get enabled and you can submit this form. Once the form has been submitted, within 24 hours it will get activated for you, and once it has been activated, you will get the notification on TradingView itself that now you have access to the indicator, and then you can enjoy it for free for 7 days. All right, so now since everyone has that opportunity that you can try the indicator for free for at least 7 days, whatever analysis we will be doing will be based on the indicator, so that you can see the advantage of the indicator, how easy it makes the process for you, plus also it makes it mechanical and very time efficient. So let's go to the chart. So let's assume this was the chart which got shortlisted for us, and since the indicator is already applied, you can see the indicator is telling us that from the current market price, the nearest demand area is this drop based rally. So let's mark this drop based rally. So yes, my step 3, which was to identify the zone, I have identified the zone. Now what we need to do next is the zone available? The answer is yes. Now once you have the zone available, does not mean you can blindly trade a zone, right? Always remember, just because there is a demand zone on the chart does not mean we can use it to plan a long trade, or just because we have a supply zone on the chart does not mean we can blindly use it to plan a short trade. Once a zone has been identified, the next step is we need to qualify it based on our trade plan. And for qualification, there is a 2-step process. In step 1, we'll qualify based on certain conditions, and in step 2, we'll qualify using the booster scoring. So let's go through these conditions. The very first one is, can the zone be a case of level on top of level? Now the reason we start with level on top of level is because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area, right? So that is why level on top of level is the very first criteria we look into. Now, how do we qualify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if you have a coinciding level, the possibility is that it might be a case of level on top of level. But if you don't have a coinciding level, then it cannot be a case of level on top of level. So let's verify that first. That is the zone which I've identified. Is this a coinciding level? So how do we verify that? It's very simple. I've already marked the zone. I'll go to my intermediate time frame. Now I can also see my intermediate time frame zone. So what I'll do is I'll mark the intermediate time frame zone with a different color. So the one in pink is my intermediate time frame zone. The one in green is my lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes, which makes it as a coinciding level. So we do know that we have a coinciding level. And since it is a coinciding level, now we'll check, can this be a case of level on top of level? Now, as of now, you can only see one zone inside of it, but always remember, when it comes to case of level on top of level, it is not mandatory that all zones might be quality zones. So I'll change the indicator settings and I'll tell the indicators I just don't need quality areas. I need all demand supply zone structures on this time frame. So now you can see it is identifying all zones, but we still have only one zone inside of it, right? So which basically tells us it is a coinciding level, but not a case of level on top of level. Now, since it is not a case of level on top of level, no modification, that is the zone we will stick with. But if you have been following my sessions for a while, you would have seen that whenever I see such a scenario that this is a coinciding level, I prefer to have my stop loss from the distal line of the intermediate time frame. And the reason I'm doing this is, let's just keep it here for a second. So what might happen is, what if the prices, they come a little deeper into the zone, which is my intermediate zone, and then start moving up? So what will happen is I'll get stopped out and then it might start going in my favor, right? So this is where I prefer to use the distal in such cases of the intermediate. But is it mandatory? The answer is no. If you want to go something like this, you can also keep it something like this, because like I always say, different traders, different personality styles. Narrower zone have their own advantages and disadvantages. Wider zones, they have their own advantages and disadvantages. It is you who have to see what best suits your personality style. So I prefer to use it something like this. So I would mark the zone using the distal of the intermediate. So now we have identified our zone. We have checked the very first case. It is not a case of level on top of level. Now this zone is not because of a gap, therefore gap rules will also not apply. Pivot non-authenticity definitely applicable. Why? Because this is a drop-based rally structure, and to drop-based rallies we always apply pivot and non-authentic rules. Now, what is the rule for pivot non-authentic? The rule says that the move from the zone should have violated one opposing zone on the intermediate time frame if I'm using the aggressive approach. So currently you can see an opposing zone has not yet been violated. So if I'm going with the aggressive rule, this does not qualify for me. And similarly, if I go with the conservative rule where we need a pivot high, that has also not happened. So the fact remains that irrespective whether you're using the aggressive rule or whether you're using the conservative rule, this is not a valid trade for us as of now. So what I'll say is that this can be a conditional trade. Why conditional? Because once this condition has been satisfied, once price goes above this distal line, then this trade will become as a valid trade for us, right? Let's say if I'm using the aggressive rule, it will become valid for us. But the reason I'm still okay with planning this trade, right? So I'm just going one step ahead, is because you can see here it is a rally-based rally structure and I'm basically using the same zone. So even though it looks like a drop-based rally on the lower time frame, here I can see it's a rally-based rally structure. If I still want to use it, acceptable. But yes, let's say if you want to be a little on the conservative side, then wait for the violation of this distal. Once this distal is violated, using the aggressive rule, this will get qualified for us, right? So yes, this can be a valid setup eventually. As of now, if I go with the aggressive rule or conservative rule, this will get disqualified. All right, so let's move ahead. So pivot non-authentic, it might get qualified, but I also gave you a reason because of the intermediate structure, I can still use it. Unstable equilibrium not applicable. So after applying all the applicable rules, is the zone qualified for us? The answer is yes. But if you want to be on the conservative side, it will only get qualified for you once that intermediate time frame zone gets violated. Supply gets violated, right? So now that we are done with the conditions, let's look at the booster scoring. So let's go back and let me bring up the booster sheet. The first one is freshness. The zone is definitely fresh, gets a score of 3. Strength, we have an explosive move. Time at the zone, we only have 1 candle. Reward to risk ratio, we'll take it as an assumption. Location, if I go to the monthly chart, you can see that we are planning our trade at the best location. So best location gets a score of 2 again. Talking about trend, at best locations, trends, they become irrelevant. It doesn't matter whether you're in an uptrend, downtrend, or sideways. All these trends can be traded with a score of 1. But you can still see that we are in an uptrend. But even if this would have been a downtrend, it will still get a score of 1. Right? Move from the zone, we need at least... because if you're looking for a 2:1 target, we need at least 3:1 move, which has not yet happened. So currently it is going to be a score of 0. But what can happen is if the prices, they move up and then it starts coming back, this can upgrade it to a score of 2. A level on top of level not applicable. We have already verified this, but it is definitely a coinciding level. And talking about traps, so again, you can see as soon as some zones were formed, we are getting these alerts. So yes, talking about trap, if I take a horizontal line and start pushing it up, you can see almost this area has been working like as an area of resistance in the recent past. You can see resistance, then it was acting like support, acting like resistance, almost support. Here also acting like support. So we have a pretty clean area of support and resistance, which is sitting right above our zone. So what is going to happen? People who believe in support resistance, once the prices they reach here, they would like to buy because they will assume this to be an area of support, and their stop losses, which will be sell orders, will be placed below this area. Similarly, if we get a breakout, people who believe in breakout trading will also start selling. So we understand by the time we enter into this area of demand, we'll have a lot of selling coming into the market because of the stop losses, because of the breakout traders. And what these traders are doing now is they are making 2 key novice mistakes. Mistake number 1, they are selling after a decline in price, which means they are selling at a cheaper price. And mistake number 2, they are selling in an area where the chart has proven to us that back in history, demand was more than supply, which could only be the reason for the prices to move up. So yes, that possibility is there, that this might work like a trap, for which I'll again give it a score of 1. So if you look at the overall scoring, we have a high quality zone with a score of 10 out of 10, definitely with the assumption of reward to risk ratio. and a high probability setup with a score of 5 out of 8, which makes it as a type 1 trade because it is a high quality, high probability setup. So after applying the boosters, we got to know this can be a type 1 trade for us. Now, no matter how high the quality or the probability, any trade can be a stopped out trade. So we also need to be ready for the worst case scenario, for which we'll do a proper position size calculation. Now, whenever the prices are back, we'll always have to re-verify because the markets are not static, markets are dynamic. Conditions are changing almost every other second. So before entering any trade or placing our order, we always have to re-qualify. The way we qualified it as if now, we'll have to again re-verify that does it still qualify based on my trade plan. If the answer is yes, you place your order, in this case a type 1 trade, and once your order has been executed, the last step is your trade management, where first step is at 1:1 we make it as a break-even trade. After that, if you get the opportunity to trail onto it, you start using your trailing stop loss. So this is how we plan trades, very mechanically, very rule based. And if these sessions are helping you plan better trades, then do like the video. If you're not subscribed to my channel, do subscribe so that you get updated whenever these live sessions are happening and you can join in live. And the most important thing which I would like to add is that I'm pretty sure that you people also understand that a lot of people, or I should have said a lot of traders, are struggling with planning trades, managing trades, right? How to plan it correctly. And all this content which I'm sharing with you, be that my course content, be that these live sessions, they are 100% free. So the more you spread it, the more traders can take advantage of it, right? So do spread it in the community. If you're part of some trading group or if you're part of some trading community, do share it with your fellow traders so that more and more people can take advantage of it. Now, like I always say, at the end of the session, I'll be taking your questions, queries. But before I do that, one feedback which I was getting from you people was that yes, you do take the questions, queries at the end of the session, but what if I don't want to ask my question publicly, or what if I want to share my analysis, which is not possible during the YouTube live chat? Do you have any option? The answer is yes. When you visit our website, you can see on the top right corner you have this option which says 1-to-1. So from here you can schedule a 1-to-1 appointment with me. There are two kind of appointments available. One is a voice call where you can schedule your appointment. I'll call you wherever your scheduled appointment time is, and then we can have a telephonic conversation. You can ask your questions, doubts, queries. I help you with them. The other one is an online meeting. So if you feel that you want to share your screen, you want to share your analysis, you can also go for an online meeting, right? So these two options are definitely available. But yes, you can always ask your questions during the live session, and that is the main idea behind why I take live sessions, so that we can have that interaction. If you have any challenges, questions, queries, always put it in the chat box and I'll answer it at the end of the session. So let's see what questions, queries we have today. Okay, for screener, are there any limitations for the input list? In your demo it was 15. So yes, there is a limitation, and that limitation is you can only input. If I go back to the screener, let's hide this. If I go to the screener, you can only input up to 15 symbols, right? But now there are alternatives to it. So let's say I have a list of 150 symbols I want to analyze. Now somebody who has a free TradingView account, right? So just give me a second. I'll just quickly show you how you can do it. So somebody who has a, just a minute. Right, so this is what I can do. Let me add the indicator again. So let's say demand supply screener. And now let's assume I have a free TradingView account and my list of symbols is, let's say, maybe 150 symbols. So what I can do is I go to the settings, right? And I can take my list of symbols as a CSV. Can you see here I've added the first list. So this is the first 15 symbols. I'll wait for the results to show up. Can you see in this first 15 symbols, I just have to look at 3M India. Then I can take my list of next 15 symbols. So even if you have a free TradingView account, can you see changing the list is as simple as just a copy paste? Can you see it's my next 15 symbols? So from the first 15, I got to know maybe I can look at 3M India. From here, I can look at this particular. Well, now once this result is done, now I can again go to the settings. I can again change it. So can you see within few seconds I've already analyzed 45 symbols, even though I had a free TradingView account. Now, if you have a paid TradingView account, then what you can do is you can apply this indicator 4 times. So now just as an example, I can say copy and 2, 3, 4. In fact, let me keep it as 3. So the first one can be on the top right corner. The second one can be at the bottom left. And the third one can be at the bottom right. Right, so now what I can do is I can have all 3 of these running together, but with a different list of symbols. So a different list of symbols on this one and a different list of symbols on this one. So can you see on one chart, now I'm looking at 45 symbols. I can even, input one more. I can use the left corner if I wish to. Now this is one chart, right? Now I can similarly have it on another chart. Now just as an example, I have a 8 chart layout. So on all these charts, I can apply it multiple number of times, and this is one layout. Then I can have multiple layouts. So yes, you can have n number of symbols depending upon what TradingView account type you have. But yes, this is, you do have alternatives if you want to scan more than 15 symbols. So even on a free account, it is as simple as just a quick copy paste to give you a next list of 15 symbols, and the scanner will still work for you. So I hope that helps you understand that yes, even though there are some limitations, but we can go around with those limitations in a very easy way, right? So that's how the indicator has been designed, that even for somebody who has a free account, you can easily copy paste as a CSV and you can get your results from the screen now. All right, so that answers your question, and that brings us to the end of today's session. Thank you everyone for joining in. Next, I'll be seeing you most probably the next weekend. Until then, trade safe, enjoy your Sunday. Take care. Bye-bye.